Hello and welcome to our webcast. I'm Danielle Johns with Moss Adams, and I'm going to get us started for today's session, Fall Not-for-Profit Tax Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now, I would like to introduce today's presenters, Pamela Alexanderson and Jane Coleman. Pam is a partner and Jane is a senior manager here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now, I would like to turn the floor over to Jane to get the presentation started. Jane?
Great, thanks so much, Danielle. Good morning, everyone. Hope you all are doing well. So today, Pam and I will be going over some recent tax rulings and updates. There's been quite a lot going on lately, both COVID-19 related and also non-COVID-19 related. And we will also be discussing the proposed changes affecting donor advice funds, which have been an increasingly popular way to give back over the years. So first, I'll start with the Infrastructure, Innovation, and Jobs Act that President Biden signed into law on November 15th of 2021. And it touches on everything from roads and bridges and transportation to the country's water, energy, and broadband system, while also addressing climate change. There are also a lot of provisions in here that benefit schools and nonprofits, so I wanted to highlight a few of those. So there's a provision in here that dedicates $15 billion for grants to clean up drinking water by removing lead-contaminated pipes and making other updates to current infrastructure. It also includes setting aside at least $25 million per year for small and disadvantaged communities. There's also $5 billion dedicated to upgrading school buses to more clean energy, cost-efficient models and giving priority to the low-income, rural, and tribal school districts. This bill also dedicates $65 billion to improve the country's broadband infrastructure, especially in the unserved and underserved areas. The goal is to increase the affordability and accessibility of quality internet, regardless of where you are located. The bill also dedicates $1 million per state to create safe routes for students to walk or bike safely to and from school within a 2-mile radius of campus. This is designed to increase safety and to encourage alternative transportation methods, as well as healthy, active lifestyle choices. There's also a pilot program called Energy Efficiency Materials, which would fund $50 million in grants to nonprofits to make energy efficient upgrades to their facilities. The Department of Energy would oversee this program, and it will provide grants of up to $200,000 for each nonprofit project. So nonprofits could use this funding for new energy efficient HVAC units, generators, doors, windows, roofs, and lighting systems. Currently, the legislation is light on details in terms of the specific criteria required to qualify or when or how to apply, but it does say that the program will run from 2022 through 2026, and that organizations exempt under 501c3 can apply. And when providing these grants, the Department of Energy will be looking at the amount of energy savings this project achieves, the cost effectiveness when using such energy efficient materials, the organization's plan for evaluating, measuring, and verifying energy savings, as well as the organization's overall financial need. One downside, however, from this infrastructure bill is that it discontinued the Employee Retention Tax Credit, otherwise known as the ERTC, which was originally introduced as part of the CARES Act back in March of 2020 and was extended through June of 2021. And then the American Rescue Plan Act extended it through December of 2021. But this infrastructure bill backtracked and changed the expiration date for the ERTC to September 30th of 2021. So some organizations were already claiming these credits for the fourth quarter of 2021 based on their eligibility from the third quarter, and they will now need to pay back those fourth quarter credits that they claimed. And heads up, we are expecting to see audits of this credit. The American Rescue Plan Act extended the statute of limitations from the normal 3 years to 5 years for ERTC's claims. And as far as the timing for refunds and credits, the IRS is still very behind in trying to catch up. It's been taking them on average 4 to 5 months to process these ERTCs. I know some of our clients are starting to see refunds and credits recently for ERTCs for the ones that they submitted for second quarter of 2020. So it's taking a while, but the IRS is working through these. Moving on to the Build Back Better Act. The House passed its version of this last Friday. And it still needs to work through the Senate, so it's not final yet, but I wanted to highlight a few provisions that's currently in the House version of this bill. One item the House was wanting to do is to phase out the excise tax on net investment income under Section 4968 for the institutions that provide qualified aid awards to first-time, full-time undergraduate students. Other provisions the House wanted to do was to include a tax credit for donors equal to 40% of contributions to certain certified public universities if it's used for research infrastructure. as well as making federal Pell Grants fully excludable from gross income. The current House version also created a new refundable tax credit for certain higher educational institutions as part of a qualified environmental justice program, and making the American Opportunity Tax Credit available to students convicted of a felony related to the possession or distribution of a controlled substance. So again, this bill is currently working its way through the Senate and will most likely have a lot of changes. So we'll see if these provisions make it to the final version. So as many of you already know by now, there were a lot of provisions that came out of the Tax Cuts and Jobs Act of 2017, aka the tax reform, that affected the non-for-profit world. Over the last few years, we saw a lot of movement on these provisions in terms of regulations issued. So final regulations have been issued on the UBI silo rules, the excise tax on compensation over $1 million, and the excise tax on net investment income of private colleges and universities. For the UBI silo rules, friendly reminder that when looking at your investment silos, the transition rule was not grandfathered in the final regulations, unfortunately. So organizations with taxable years after December 2nd, 2020 can no longer rely on this transition rule. So in other words, if you acquired an interest in a partnership before August 21st, 2018, and you've determined that it's not a qualified partnership interest, then you will now need to go through that look-through analysis to determine if there's a separate unrelated trade or business to worry about. Also related to the UBI silo rules, the IRS is working on proposed regulations to give more guidance on expense allocations and net operating losses, considering that the CARES Act temporarily removed the 80% limitation. So for tax years beginning after 2020, you can use 100% of your NOL against your taxable income. And as many of you probably have already heard by now, the provision on treating employer-provided parking as UBI was repealed in December of 2019, and the IRS released guidance on how to file amended NAETs to claim refund or credit of the related taxes paid. The latest IRS update on this is that they are still working through these amended returns. In general, again, they're extremely backed up because of COVID and are still trying to play catch up. I know we've filed a lot of amended NAETs over these last 2 years for our clients, and I personally haven't seen any of our clients receiving their refunds yet. And as you've probably noticed this past fall busy season, the IRS released the 2020 NAET, which has been redesigned a bit. So there's now a new Schedule A, which is a replacement for the Schedule M that we had before. So now each separate UBI activity is reported on its own Schedule A, and the first page of the NAET is a summary of all of those activities. So not a huge difference. If anything, I think it's a little bit more intuitive. Which brings us to our first polling question.
Great, thank you, Jane. Our first question is, how many different Schedule A's is your organization filing with the Form 990T? Is it A1, B2, C3, D, 4 or more? I'll give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. If you can't see the submit button, please enlarge the slide area. We'll give everybody just a few more moments. Get your responses in. And here are our results.
Great, so it looks like most of us have just one UBI silo, and some of us have 4 or more. I fall into the 4 or more category. Okay, so one of the goals the IRS has had these last 2 years was to modernize its technology. And so as a result, the IRS is now requiring that all forms 990, 990 EZ, PS, and Ts be e-filed. For 990s and PS, this e-filing requirement is effective for organizations with tax years beginning on or after July 2nd, 2019. For the EZ, this e-filing requirement is effective for organizations with tax years beginning on or after July 31st, 2021. For the T, all 2020 forms need to be e-filed as of March 15th, 2021. The IRS did provide a grace period where they will accept paper filings of the 2029 ATs, but only if it was postmarked on or after March 15th, 2021. Beginning January 31st, 2020, the Form 1023 must be e-filed online at the IRS's pay.gov website. And finally, the Form 4720 is required to be e-filed for 2020 forms as of July 16th, 2021. So I know I just threw out a lot of dates just now, but the general takeaway here is that the IRS is now requiring that all of these forms be e-filed. And in general, I know this rollout of the e-filing requirements haven't exactly been smooth, especially for the PS and the Ts. I know a lot of us have experienced issues with trying to e-file this past busy season, but the AICPA was working pretty closely with the IRS on resolving these e-filing issues, and I did see an improvement as we got deeper into this past busy season. A friendly reminder, there's a flat 1.39% excise tax now on net investment income for private foundations for tax years beginning after December 20th, 2019. Before, the tax rate was either 1% or 2%, depending on whether the private foundation's qualifying distributions met a certain threshold. Also, the Secure Act disallowed contributions to an IRA for individuals older than 70.5 years of age to be rolled to a charity. Another big project the IRS has been working on is regarding its group exemption program. So this is where the IRS recognizes a group of organizations as tax exempt if they are affiliated with a central organization. So this avoids the need for each of the organizations to apply for exemption individually. The IRS published in May of 2020 the proposed revenue procedure notice 2020-36 that provides updated conditions for obtaining, maintaining, and qualifying for group exemptions. The previous authority on this was Revenue Procedure 80-27 that was issued all the way back in 1980. So it's been a long time since the IRS has addressed this area. A lot of requirements have remained the same, but it does include new requirements for central organizations to obtain group exemption and now must have at least 5 subordinates. And for the subordinates, it includes 4 new requirements, 2 of which are new matching requirements. So the first matching requirement is that the IRS now wants all subordinates to be described in the same 501c subsection. And the second one is that all subordinates must now be in the same 501c subsection as the central organization. And just to take this a little bit further, if the subordinate organizations are described in 501c3, then they all must be classified as public charities under the same paragraph of 509A. But those classified under 509A1 are not required to be classified under the same paragraph of 170B1A. In other words, you can still have churches, hospitals, and schools under the same group exemption. But the IRS feels that these matching requirements make exercising general supervision and control easier since they'll all be subject to the same requirements, and the proposed revenue procedure also defines the terms affiliation, general supervision, and control, which were undefined before. The IRS actually has stopped accepting group ruling application requests as of June 27, 2020, until final revenue procedures are issued. The latest on this is that the IRS is still working on it and that there's no ETA, unfortunately, on when it will be available. So pending publication of the final revenue procedure, the Rev Prog 80-27 from 1980 continues to apply. Other topics, the IRS released frequently asked questions on contributions of virtual currency and receipts by the charity on their website. So take a look at that if that applies to you. The IRS also released guidance on circumstances under which an LLC can qualify for recognition under 501c3. And friendly reminder, the Form 1089 NEC has replaced the 1089 miscellaneous box 7 for non-employee compensation reporting, starting with the 2020 payments. And a quick update on the Mayo Clinic ruling. The IRS recently announced an action on decision that it will not acquiesce to the 8th Circuit's holding, and the IRS will continue to litigate the issue. So this was the legal dispute that's been going on for over 5 years now, with about $11.5 million at stake. So this ruling was a big one where the courts ruled in favor of Mayo Clinic and against the IRS. The Mayo Clinic is a 501c3 in Minnesota, and it's a parent organization of several hospitals, clinics, and it's also a parent organization of a college of medicine and science. And that college is comprised of 5 distinct medical schools that offer degrees in continuing medical education. So the IRS says that the Mayo Clinic was not considered an educational organization and therefore owed tax on their debt finance income from real estate investments. But the court disagreed and said that Mayo Clinic engaged in both educational and non-educational activities, and that the non-educational activities were incidental to the educational activities. So in the court's mind, Mayo Clinic qualified as an educational organization and therefore could exclude their debt finance income from real estate investments as UBI. But the IRS is still very adamant about their case and is still fighting the court's stance. So we'll see how this plays out. So the IRS is still requiring Schedule B donor information for 501c3s and 527 organizations, but they're not requiring it for other Form 990 filers. So they're not required for C4s, C5s, and C6s, although some states may still require this information. Most recently, the U.S. Supreme Court announced its decision on Schedule B detail for the state of California and held that the California law requiring nonprofit organizations to disclose donor information in the state of California was unconstitutional. So that was a big win for donors, and the California Attorney General updated its RF-1 instructions to say that the 990 attached to the RF-1 should still be the filing copy, but you can exclude all pages of the Schedule B. The AG's website did specifically say to not attach the public disclosure copy of the 990. So you still want to attach a filing copy of the 990, but you can exclude all pages of the Schedule B. The state of New York recently also announced that they won't require Schedule B detail either for public charities. So it'll be interesting to see if other states follow suit. A pretty popular way to give back to people these days, I've noticed, are through crowdfunding sites such as GoFundMe. So the IRS released a revenue ruling as to whether contributions of money received through these crowdfunding sites to pay for medical expenses are excludable from gross income on the grounds that these contributions are gifts under Internal Revenue Code 102. And the guidance release regarding charitable contributions of inventory is pretty relevant these days as well. I would imagine as restaurants that are not operating at full capacity yet due to COVID and the related labor shortage may have excess inventory and could donate their food inventory to charitable organizations and food banks and claim tax deductions for the charitable contributions. And Congress is likely to reintroduce and consider the Charitable Conservation Easement Program Integrity Act, which would cap charitable deductions for syndicated conservation easements at no more than 2.5 times the adjusted basis for an investor's share, and would require a 3-year holding period for the property. And just a quick update on AB 5. This went into effect as of January 1st, 2020. So this is that new ABC test for California to determine if workers are employees instead of independent contractors. So as a result, there may be occupations that often in the past would be treated as independent contractors may now be roped in as employees instead, and employers may be on the hook for more payroll taxes. California voters did pass Proposition 22 back in November of 2020, which allowed app-based transportation and food delivery occupations like Uber and Lyft and DoorDash to be carved out of the ABC test. So these firms can continue to classify their California workers as independent contractors instead of employees. And finally, the tax-exempt and government entities unit at the IRS released its program letter outlining their priorities and focus for fiscal year 2021. They plan on continuing to collaborate across the IRS on existing and emerging issues, such as syndicated conservation easements and abusive charitable remainder annuity trusts. They will continue to focus on supporting tax compliance in the global high net wealth arena, especially for private foundations and retirement plans of closely held businesses, such as employee stock ownership plans, and they will continue to focus on technology and data analytics, as well as developing and training and hiring their workforce. Which brings us to our second polling question.
Thank you, Jane. What is the excise tax rate on net investment income of private foundations for tax years beginning after 12/20/2019? A, 1%, B, 2%, C, 1.39%, or D, 1.93%. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I would also like to take this time to remind you to submit your questions for the presenters in the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And here are our results.
Okay, great. So it looks like most of us got it right. It's C, 1.39%. Okay, so now Pam will be taking over and talk about the proposed changes to donor advice funds.
Okay, thank you, Jane. It's a pleasure to be with everybody today. I'm going to focus the second half of the presentation on the recently introduced ACE Act, which is the Accelerating Charitable Efforts Act that was introduced in June of this year by Senators King and Grassley. And what this act does is establish a number of rules with respect to donor-advised funds that replace some of the existing rules we've been under for quite some time. So I'm going to go over the different rules with respect to these different donor-advised funds, and then I'll also talk a little bit about some changes to private foundations with this particular act. But before we get started, I thought I might just give the audience a little bit of history on donor-advised funds so that maybe set the preface for maybe why some of these rules are being introduced. So a donor-advised fund is basically a fund or an account, and it actually has its own internal revenue code, which for those of you that are interested, it's 4966 D2A. And basically, this is a fund or account that's separately identified by reference to contributions of the donor or donors. It is controlled by a sponsoring organization, and those donors or donors should expect to have some sort of advisory privileges as to the distribution of funds held in that account. And so in terms of a little bit of history, these funds have been around for a very long period of time. They were actually established in the 1930s by the New York Community Trust. And then the Tax Reform Act of 1969 added a code section that created a subcategory of private foundations that have donations pooled into a common fund. And that term's pretty important because that pooled into a common fund basically was the old way that we used to reference donor-advised funds. Between 1987 and 2000, there were a bunch of cases and publications that were introduced regarding donor-advised funds, and then we start to see the need for regulation. In 1997, Fidelity Investments became the first commercial sponsor of a donor-advised fund. So again, they've been around, at least 2 decades with the actual name donor-advised fund. And then the Pension Protection Act of 2006 provided some rules regarding prohibited payments to donors and other rules about donor-advised funds. And then there was actually another Tax Reform Act in 2014 that was proposed that was never enacted. But this is where we started to see some excise taxes introduced if contributions to donor-advised funds had not been distributed within a period of time. And so as we've gone through probably the last 30 or 40 years, the legislators have seen the need to put more regulation around donor-advised funds. And really what they're trying to do, it appears, is make sure that there's no wealth accumulation in a donor-advised fund. So there's currently about $140 billion sitting in the nation's donor-advised funds, and the lawmakers want to see that money move out of the donor-advised funds and actually make it to an intended charitable class of people. So with this particular act, they have proposed establishing 3 types of donor-advised funds: qualified, non-qualified, and then a qualified community foundation donor-advised fund. So I'm going to go into the rules about these different types of funds, at least as they're proposed, and then talk a little bit about private foundations. Okay, so a qualified donor-advised fund is a 15-year donor-advised fund, and the donor will get the tax deduction, as they do under the current law as it's written, in the year of donation, but only if that donor commits those funds to be distributed out of the DAF within 15 years of donation, or the account holder relinquishes advisory privileges, which is probably not going to happen. In order as well to get the deduction, the charitable deduction, the donor has to receive that contemporaneous written acknowledgement of the distribution amount. And I just want to remind all of you on the phone what contemporaneous written acknowledgement means, because it's really important that donors get the exact information they need in order to substantiate their deduction. So in order to meet that requirement, you have to have the name of the donor. You have to have a certification that the asset was sold for cash and the amount of cash received in the sale. Certification that the qualifying distribution had been made from those contributions or proceeds of the sale. And then acknowledgement is contemporaneous if the sponsoring organization provides it within 30 days roughly of the donation. There's a few other rules about that. But very specific contemporaneous written acknowledgement that needs to be provided to the donor. If, in order to get a deduction for a non-cash asset, such as stock, it would be based on the cash received from the sale of the asset that's made available to the DAF account rather than the appraised value of the asset. And the penalty for failing to distribute those funds within 15 years is 50% tax on the remaining asset. And our understanding here, although it's not expressly written as a rule, is that likely the sponsoring organization will be responsible for that tax, not necessarily the donor. It isn't specific with respect to who pays it, but our general feeling in the industry is that it's probably going to be a tax paid by the sponsoring org. Okay, so I'm going to talk a little bit about a qualified community foundation DAF. And it is also a 15-year DAF, but it's a DAF that's controlled by the community foundation if it meets the following requirements. And there's a $1 million cap on these particular, there's not a cap on the donor advised fund, but the rules change based on that $1 million cap. So the maximum value of advisory privileges is $1 million per donor advisor. But if under $1 million, then that community foundation donor advised fund is not subject to the payout rules. The minimum payout for DAFs aggregating more than that $1 million cap is 15 years. So again, where they're subject to the 15-year payout requirement that we just talked about. So a little bit different than just a normal DAF, but still that 15-year payout requirement as with a regular DAF. Okay, then we have what's called a non-qualified donor advised fund. These are 50-year donor advised funds. And the kicker with these is that there is no deduction for a charitable contribution from the donor until the donated funds are actually distributed. So this might be a little bit of an accounting nightmare for the donor, the sponsoring organization, because the amount of the deduction is equal to the qualifying distribution. There will not be a deduction for charitable contribution of property other than cash unless the sponsoring organization sells the property for cash, which is usually not difficult when you're receiving donations of stock. I think most sponsoring organizations have policies in place that those are immediately sold for cash. But if there was some other non-cash donation that may not be quite as easily converted to cash, you have to wait for that event to happen in order to get the deduction, and then there has to be a distribution. All funds in these 50-year DAFs must be distributed within 50 years. And the penalty for failure to distribute is also 50% of the remaining assets in the DAF. And we also feel like this will likely be a tax that the sponsoring organization would be paying. Okay, little bit switching gears here, contributions from DAFs for determining public support. So there are some changes with respect to this. So public support is part of a 990 if the organization is a publicly supported charity. And with respect to the changes in the calculation, when a contribution to a public charity comes from a DAF, the change is basically that support from the DAF will be treated as coming from a single person, so that all amounts from that sponsoring organization would be treated as made from one person when subject to the 2% limitation. So it could be, you know, depending on the size of the distribution, that you might have a tipping problem, or you might have a problem with lowering a public charity's public support percentage with respect to this rule. If the support is identified specifically with a donor or a donor advised fund, and it's specifically identified by the contributor, then the distribution for public support purposes would be treated as made by the donor. So it's really important if this rule goes through, for organizations to understand how to calculate their public support test when they're receiving support from a donor advised fund. Okay, so we've got another polling question.
Poll question number 3, true or false? A sponsoring organization of a qualified donor advised fund would be subject to a 50% penalty on the remaining assets for failure to distribute funds within 50 years. A, true, B, false. Oh. We'll leave this up for a little bit longer. For those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of the webcast. And here are our results.
Okay, so the correct answer is true. So 63% said true. You know, hopefully this would never come to fruition, because that's a really massive penalty for failure to distribute, and especially because the time frame is so long, 50 years. I hope that would never happen to anybody. It would be quite a waste of charitable contributions. But if this were to occur, and the sponsoring organization did not distribute those funds, then it would be subject to that penalty. Okay. Okay, so we're going to talk a little bit about private foundation distributions to DAFs. This has been quite a source of conversation, I would say, over a number of years, with some people thinking that, you know, it should always be okay for private foundations to make distributions to DAFs, and other people thinking that should not be allowed. So I want to talk a little bit about the current legislation, and then we'll move on from there. So currently, private foundations can make distributions to donor-advised funds established by the private foundation at a sponsoring organization to satisfy its 5% annual payout requirement. So for those of you that aren't familiar with private foundations, they do have an annual 5% payout requirement, or be subject to an excise tax. However, we did get IRS Notice 2017-73 that requested comments on whether a contribution to a DAF should be considered a qualifying distribution. So at issue is really the timeline of that DAF distribution to the eventual charitable organization, and then some concern in the IRS that private foundations are using DAFs to avoid the actual payout requirement, because the money is going to a DAF, which then has to distribute it to an eventual charitable, for eventual charitable purposes. So there's a lot of critics, some of which who have devoted their careers to donor-advised fund reform and are in favor of the IRS disallowing or limiting the private foundation qualified distributions to DAFs. So I'm going to read a couple of quotes here from people that might be some of the strongest critics, but one person called it a fraud on the American taxpayer and a way for the affluent to have their cake and eat it too. So there's pretty strong opinions. I think people are either for a private foundation distribution to a DAF or they're against it. I really don't think there's a lot of middle ground there. On the opposite side are equally opinionated advocates of the IRS maintaining the status quo and continuing to allow those distributions from private foundations to DAFs. Specifically community foundations like the Council on Foundations. There's an awful lot of members and which are proponents in saying that they have a real stake in any charitable giving reform and have urged the IRS not to implement any rules that restrict the private foundation's ability to use those DAFs, as it will, again, quote, tie the hands of the donors. So another person basically says don't clip the wings or even chisel away at the golden goose because there may be ramifications with respect to donations for that. So people are pretty well divided on whether or not this should be something that should be allowed or not. So obviously it is allowed today, but really this is just giving us some insight into the fact that the IRS is concerned about how private foundations are using DAFs with respect to those payout requirements. Okay, so with respect to the proposed legislation, so this is proposed again, not law at all, but private foundations cannot meet their 5% payout requirement by using distributions to make a grant to a DAF unless that DAF makes a grant of those same assets during the same year. So basically, I'm not even sure why the private foundation would do that, you know, unless it's kind of a tipping issue, perhaps. Maybe it would be better for the public support test coming from, for those assets coming from a DAF as opposed to a private foundation. The other thing that's pretty significant is they cannot meet their payout requirement using distributions to pay salaries, administrative expenses, or travel of any disqualified person except for the foundation manager. Unless the foundation manager is a family member, then those payments will not count. So for private foundations out there, when you're doing your allocation of expenses between net investment income and charitable, it's perfectly okay to allocate salaries as a charitable expense. So under this legislation, that would change. Private foundations would be able to claim an exemption from the annual excise tax if their governing documents include a clause for dissolution within 25 years. And if the private foundation has not made any distributions to disqualified private foundations within that time, or you have to pay out 7% of your assets annually as opposed to 5%. So this is not saying that a private foundation has to sunset within 25 years, but it would increase the payout requirement to 7%. So, you know, again, a little bit troubling. You can kind of see a theme here that the regulators are trying to set a timeline with respect to donor advised funds and private foundations in terms of their life expectancy or increased payout requirements. Okay, couple of other things in the proposed legislation is that when filing the Form 990-PF, there will be some additional disclosures. The dollar amount of each contribution to be held in the DAF would need to be disclosed. The name of the sponsoring organization holding the DAF would need to be disclosed, and a record of the donation advice given to the sponsoring organization. You know, some of that information can be personal to the donor advised fund, to the private foundation, and so having to make these additional disclosures may be problematic for some private foundations. For public support purposes, amounts not subject to the 2% limitation include support from sponsoring organizations that specify that support is not from a DAF and that no donor had advisory privileges. So a few additional requirements with respect to disclosure. Okay, so where are we with the status of the ACE Act? There hasn't been a lot of talk going on since it was introduced in June. As of early August, and I actually think even still today, the Senate really hasn't even taken up or decided to take up deliberations of the ACE Act. So, and I still think that that's the case today. There, if you do a search, there's really no activity. You know, obviously, I think in the country, the legislators maybe have bigger things to consider. But there is also quite a bit of opposition to the ACE Act, and so once it was introduced, those that introduced it and supporters of it may be taking some time to understand what that opposition is and figure out how they can address that before actually even taking up a debate about it. So, you know, certainly there's fear that imposing some of these time limits may actually shrink the amount of money that gets destined for charitable organizations. There's some extra requirements, I think, specifically on sponsoring organizations that may create an undue burden on them. And I think that that should be understood. And then certainly, I think there's some donor privacy issues with respect to additional disclosures that would be required. And I think that those need to be addressed. Certainly the debate is not over, and from the history that I talked about when we started the conversation here today is that there's definitely the feeling of need to make some additional requirements and rules with respect to donor advised funds. So I think that that will happen in the future, and I think that the ACE Act really tells us where people might be headed with respect to imposing law. One thing I will mention on this particular topic is I did attend a private foundation conference in September, and the presenters at that conference seemed to hint that they thought legislation would pass this year. Obviously, this year is coming down to the wire pretty quickly, so I don't think that's going to happen, but it certainly could be something that we see a lot more talk about towards the beginning of next year. Okay, switching gears here just a little bit with respect to the private foundation excise tax. So as Jane talked about earlier in the presentation, under Code Section 4940, private foundations are currently subject to a 1.39% tax on their net investment income. And in order to encourage qualifying distributions by private foundations, the 5% currently mandated under the Act exempts a private foundation from this excise tax if they can distribute 7% of the aggregate fair market value of the assets as opposed to 5%, or if there's something in the governing documents that dictates that a private foundation will dissolve within 25 years and make no distribution to other disqualified private foundations. So you know, this is kind of, especially